up, boys and girls who's and dudettes? This is Due Diligence here. And apparently, my previous videos got a lot of attention. I got a lot of comments asking questions about the short squeezing and what do I really mean by their quote-unquote force to squeeze. Not forced to squeeze, they're forced to cover. But in reality, it's a little bit harsher than you guys think. And a lot of things haven't changed. There's still a squeeze potential. Technically, they have to force to cover. But in reality, because we're living in a 21st century, and then everything's not perfect, therefore, there's some social engineering that the hedges can do that will make things a little more complicated than what really has been laid out in the SEC. And because due to deregulation back into before the 2008 financial crisis, even though it has been 12 years, a lot of the old rules haven't really changed yet. And because there's no really new law that really dictates shorts have to cover by a certain requirement or by a new law, that's why we're really operating in a moral and legal and financial gray area here. Okay, and this is going to be a long video, so if you're just looking for a price action or a price prediction for tomorrow, this might not be for you. But after you listen to this entire conversation / presentation, you probably will have a very thorough understanding of how exactly really the short squeeze works. Like if you just listen to other YouTubers, they're just going to tell you to buy and hold. That's how short squeeze happens. That's not really how it works. And then in this case, in a case of a reverse merger, it is more of a it has some it's its own nuances, and due to our current political and our current time period, which is 2021, where Wall Street bet is mainstream and people are just overuse the word short squeezing, which makes the hedges adapt to a new style of combating us short squeezers. Therefore, their covering methods and their covering their covering techniques becomes more elaborated and becomes much more complicated and much more convoluted. But I'm gonna break it down for you, and using very simple terms without going into too much in detail of how exactly it works financially speaking. And we're probably going to do minimal amount of math, because apparently every time I do a math problem, you guys just don't watch. So whatever. Alright, boys and girls who didn't do that, let's just get right into it, okay? So the reason why you're here, you want to listen to me talk about or explain or educate you on the reality of short covering in MMAT, or in this case, formerly known as TRCH, right? So in my other videos, I was saying that because it treats this as a business termination or ticker termination, that's why the shorts have to cover. Well, I wasn't 100% right, but I wasn't wrong either. You see what I'm trying to say here? It's a little bit convoluted than you think, okay? And as I indicated before, or in comment sections where some of our subscribers are asking these really good questions about, do they have to cover? Like, what is going on? Aren't they supposed to cover? Or like when I call my brokerage, they're like, oh no, it's just a renaming. No, it's a renaming. They still can't open their position. Well, legally speaking, those customer service people are not correct. But in reality, they're sort of correct in form, but not in how it's really done. So basically how it works is when you establish a position or a relationship with your prime mortgages, or not prime mortgage, with your prime broker or with your brokerage firms, you can actually call them and negotiate deals, right? So if you actually trade, my mentor used to trade options or blocks of options, like off the market, third market, or on the market, or whatever. And then when you negotiate with your brokers, you can actually negotiate your deals. So when you open up a short position, you actually can negotiate the terms with your brokers. Okay, and when you negotiate the terms with brokers, especially in a reverse merger situation, it's very different from when it's a regular acquisition situation where when, say, TD Ameritrade decided to bought the platform from Thinkorswim, and Thinkorswim used to have a ticker, and then now it got acquired, so then everything moved over to TD Ameritrade. It's a different situation. Reverse merger is very special. Okay, and people were saying that SPACs are reverse mergers. They function similarly, but at the core, the formality and the core, the function of, they're different. Okay, at core, they're essentially different, but in formalities, they operate similarly. Okay, I'm not going to get into all of those, and if you have a question about those, comment down below, and just like the video, comment down below. If we have a lot of people who are asking questions about like what's the difference between reverse merger and a SPAC, and you want to know about SPAC or reverse merger, I can make another video to talk about this, because this video is going to be very, very long, because before I can explain how short covering really works in this situation, I have to sort of okay, so basically, before I got into all of that, right, we have to talk about disclaimers, right? We're not financial advisors, okay? We're not giving out financial advices, so all contents are for entertainment purposes only, okay? And we laugh about it and all those, all the shenanigans, all the formality and everything. And another thing is, in here, we're actually going to interpret some laws and SEC rulings, okay? But the thing is, we're not attorneys here, okay? So our interpretation of the law and the SEC rulings are purely our personal opinions, okay? And due to and a lot of the things we're talking about is kind of sensitive, because we're going to go into like how hedge funds actually manipulate the market, and then I'm going to put quote unquote manipulate, because I don't want to get in trouble for that. So if we piss off some big boys by just pushing this video out or pushing this harsh reality video out or review out, please like just forgive us, give us a notice, and we'll take this video down. I know like a lot of hedges are making money from like using this gray area rule or the things that we're doing, we're going to talk about. So then if we actually piss someone out, we don't want to get death threat, or I don't want my position got squeezed all the time, and later on maybe I would establish my own hedge fund, even though my hedge fund is going to be the good guys, okay? And I don't want them to like flag me or do anything, because I'm still young, I still have a career, just because I understand more about the market, just because I can see through like all the shenanigans, all the fucking bullshit, and understand how really institutional investing works, and how institutional investor and retail investor always are gonna have some sort of conflicts of interest. That's why I put the last clauses there. So for those of you who just tuned in and who just saw this video, you better watch it fast, because if we actually get flagged and then they want to tear us down, or just trying to like even do something to our channel, I still want this channel and this community to grow, so I will force myself, we will be forced to close on this video. So when it's out, it's better for you guys to spread it and just let as many people as much to watch it, to understand how it really works. And then by the time, say, maybe in 2 days, we're forced to, take it down, you guys can still, spread the words. And for those who already, watch this video, can already know what is really going on, okay? So the overview. So before I go into what is the situation with reverse mergers in this torch and metamaterials cases, I have to sort of explain to you very quickly how normal short mechanics works. Like usually, why do people cover? Like how does like short selling really works? And what are the margin calls? What does margin call really means? And a lot of YouTubers overuse the word margin calls, because they think if anything happens, like some meteorite event happens, all of a sudden your brokerage decided to margin call you, and you're essentially fucked. Or they watch the movie called Margin Call and be like, oh my god, margin calls, blah blah blah. But here I'm going to explain very, very briefly and simply of how margin call really works. And after that, I'm going to talk about like what is really going on with Torch, aka metamaterial here, like what will trigger a squeeze, and what are some previous data on reverse mergers, and what is the real covering reality here, okay? So how short mechanics really works, right? So I'm Asian, right? So I like rice, no? So So let's just say this is a rice stock, okay? So as Asian, I eat a lot of rice, and I look at the supply and demand of rice, and I was like, oh my god, the demand is gonna increase, right? Because we have more and more Asian people on the market. So if there are more Asians, therefore rice price is gonna go up, right? And because COVID happened, and because all the farming shit going on, that's why the supply of rice will go down. Therefore, the price of rice will go up, right? So how do I profit off of my hypothesis? I go get a bunch of share of rice, right? So I go get a bunch of share of rice like that. Okay. But dude number 2 here, who's always, let's just say he's a party pooper. He loves to short stuff, okay? The reason why he loves to short stuff is he thinks that a lot of times, a lot of these price actions already accounted for future speculations. So in here, he thinks that the rice price is actually overvalued right now, okay? It's overvalued. So how would you capitalize on an overvalued stock? You would short it, aka I'm selling shorts, right? So how does selling shorts really work? You're essentially borrowing shares from whoever already owned the shares through your prime brokerages, or through your broker, and then you're essentially selling these non-existent. You don't own the share, but you sell the shares as if the shares worth less than it actually worth. Yes, I think I explained it right. Or not really. I explained it right, but I think it's simply right. So basically, this guy number 2, right? Dude number 2 on this channel decided to borrow shares from me to short. And what does that do? By doing that, it will drive short-termly. So when he decided to short, in a short-term perspective, the price of a stock would go down. Okay. So what their risk is what if my hypothesis is right, and then all of a sudden there's more demand, and then their price action over a long period of time will go up, right? In the case of Torch, the reason why they're shorting is because also the short sellers, okay, the shorts. This guy is very sophisticated, okay? Usually all these hedge funds who are shorting stuff, they're very sophisticated. They usually go into like a long period of time of due diligence and to look at the financial sheets of all these companies like AMC, BB, those have heavily debted, have heavily, they're losing a bunch of money over the past few years, and then they look at it and be like, oh my god, this price is definitely going to go down to a point, and they will just short it. They will short it when it's high, and then when it's about, say they short it about $6, when it reaches $2, they will just, liquidate or close their position, right? It is a very, very brief explanation of how it works. So if you guys want to have a very in-depth, I will give you examples and examples after examples. We can literally make a video on short selling mechanics alone, okay? Because a lot of users is not really explaining it, but for time purposes, because I still need to go to our main topic, so I'm just gonna explain it very briefly, very simply to this point. Okay, now we're just go to the next slide. So why would these shorts cover, right? They cover, why? Because you can simply make more money when I cover my position. So for example, we're going to get into a situation where A open up a naked short on company A, right? And then company A is engaging in a reverse merger with company B. So by the end of reverse merger complete, technically speaking, those guys are required to cover their naked shorts. But in reality, that's not the case, because what they can do is they can actually use some mechanics of the I don't really want to get into this. There's a thing called what is it called? There's a thing called. So basically, you have the obligation to cover your shorts, but you can also hide it under your balance sheet. in a way. I don't really want to get into this because this is like a total. It's similar, all pretty similar like the dark pool or whatever. It's like how the hedges hide. Like they basically make the money that they short the money that they lost in shorts into a liability, and then they park it in their balance sheet, and then they can sort of, you know, hide it for a longer period of time until somebody noticed, and then the SEC sort of investigate them. Okay, but in this case, we're not really talking about naked shorts. We're talking about, like, say, I know a merger is gonna happen, and then the merged company, the merger is gonna significantly boost up the value of the stock, and then because it's a reverse merger, you know, I short it when it's $6, and I know that in the future it's gonna definitely gonna, like, in 2 days it's gonna be $8. So I'm just gonna cover my position here. Say I'm gonna cover it right at $7 for 1,000,000 shares. So then I'm only losing, you know, $7 million. But when, say, the stock goes up to $10, I can come back and short it again, and I know it's gonna short it back to $8, which means I will make $2 per share. Okay, so it's a smarter way of closing your position to take your loss first and take your liquidated money, right? You acquire money to short. So you take all these money out, and then you can use those to either long another position or short another position, okay? And then a lot of times it's about price actions that will likely eat away my margins for free. So what does it mean is, basically, you will anticipate a bunch of DJ retail investors like me who knows that, say, MMAT have a huge potential, right? Because we believe in the product, it's essentially become a tech company now, and then we encourage a bunch of people just slowly. We don't buy it all of a sudden like Clove, right? We slowly buy it up, right? So then the shorts will know that, oh, I don't really have really a good chance of really shorting the thing. Why don't I just cover it, and I will just ride the wave with all the retail players? That's what really happens with AMC. A lot of shorts, there's only a percentage of shorts actually covered, and then they use the freed up money to actually ride the wave. That's why, you know, if you guys want me to make an AMC video, comment down below. In reality, if we're just like keep buying and holding of AMC, essentially, by the time as of I'm speaking right now, the price of AMC already like move up to $200 if none of like all the market manipulation or the shorts comes in and out, and the people inside of AMC actually are selling their stock, which makes, you know, short have more power over like certain amount of shares. That's why AMCs haven't been really squeezed. Well, all the squeezing we're seeing is essentially FOMO buying plus volume increase, which induced a gamma strike squeeze, which sort of plays in a small portion of the short squeeze. Okay, but we're not going to get into that. I think I've already spent like 10 minutes explaining this. I'm going to move fast because I don't want you guys to stay for an hour to listen to me just talk about covering and short squeezing. And then another thing is, you know, some hedge funds needs liquidity, okay? So then they are not going to get into a relationship. It's like, no, I don't want to, like, they just want to maybe do a friends with benefit or like a NSA relationship with a stock. They short it for a short period of time. They liquidate it. You know, probably their position is only like 3 months, right? The 3 months position. And they're like, at the end of second month, they're like, oh my God, we're just going to cover it. So then, you know, we don't want to lose more money, or like we want the liquidity to short something else. Another situation would be it's too expensive to borrow. Say the borrowing rate goes to 200%, which literally happened for AMC and for BB. But apparently we don't have a lot of diamond hands and for Clove. That's why we got fucked over. But this is one of the biggest reasons that they're gonna, you know, cover, because it will be too expensive for them to borrow. And, you know, another thing it will be like the things that I'm talking about, like I am required by the ticker company under certain provisions, notification agreement or other legal, or all the lawyer shenanigans where the CEO of, in our case, the CEO of Meta or the CEO of Torch comes out and telling the shorts to be like, okay, you guys have to cover. And I do not appreciate a rolling over short position. I'm going to explain what rolling over short position is. It's essentially agreement that the shorts can make with their brokerages. Okay. All right, next slide. So I'm talking about margin call. Like, how does margin work? So you have this amount is your money, right? So you have $1,000 of your money, and all the margins are essentially the borrowed money. They're leverage you borrowed from your brokerages, okay, or your prime. In this case, like prime brokerages, whatever, right? So let's say you can have 50% margin in one stock. So essentially, you can get another, $1,000. So you will get margin call only one. You cannot sustain your borrowing fee. Very unlikely, right? Because if you just look at Michael Burry, which is Mr. Big Short, he reserves a huge amount of chunk of his cash just to cover the borrowing expenses from all these years. Because I think he shorted the Nasdaq and shorted the market for over 6 months. So that's a huge amount of borrowing fee that he has to sustain. And another way of you are getting margin calls is your position goes to shitters and it falls below minimal required margin. Okay, so what are minimal required margins? So let's say the minimal required margin is 20%. Okay, so that means if your money, let's just say right now your entire portfolio is $2,000 in rice. Okay, your $2,000 in rice. So that if it falls under 20% of the total thing, it means if your asset, if somehow this part of your asset falls under $4,000, you're required to cover. But in reality, we'll have. Oh my God, how to explain it? I don't really want to put so much time into it. Basically, when a stock decrease, when you take on losses in terms of your entire portfolio, your own money get hit, not the margins, okay? Because the brokerages have to make money, so you're not eating away their margins. Like, you're eating away your own money, so then your margin get eat away. An example of this would be, say, right now it's $2,000 of the entire portfolio. $1,000 is margin. $1,000 is your own money. Okay, I'm just gonna do the quick math here. So let's say when the minimum required margin is 20%. So it means when this falls under, for 20% is 400. Yeah, I think it's 400. Yeah, it's 400. So when this value falls under 400, then you're required to cover your position. So how would it fall under 400? That would be the entire value of the stock actually go down by 600. You see, when it goes down by 600, the conventional understanding is, okay, I have 50% margin, so the margin will take 300, and I will take $300 hit, and then therefore I still have 700 left in my own account. That's totally not true. What will happen is, if you go down by 600, your own money get hit, so you will have $400 left. So when you only have $400 left, you are at the minimum requirement. Okay, minimum required margin. And then when it falls down to $399, you're gonna get a margin call by a brokerage, and you're required to cover. Okay, I think I explained it right. So if you have a question, comment down below. Now I think I explained it right, but I think just the way how I presented it might be confusing. So if you guys have further more questions, I can even just make a video explaining how margin and margin call works. Okay, next slide. So now we go to the $1 billion question here, right? The sugar baby is gonna ask the daddy, "Daddy, what's up with MMAT? What's up with this torch and material situation? And how do we force the shorts to cover?" There's no such thing as forcing the shorts to cover, even in this case. Sorry, I'm getting thirsty. Because here, I'm gonna explain to you in the next slide. So when Torchlight becomes metamaterials, or when the reverse merger got approved, established on the 25th, what really happened in the background is you have the you have the CUSIP number, which is for the ticker TRCH got terminated and it turns into a new ticker, which is changed to MMAT. So not really it's a rename, it's really a termination of the old identification number to a new ticker, technically speaking. So legally speaking, you have to cover, right? Because you one book closed, one book open. But in reality, if you want the shorts to cover their positions, it's huge amount of risk on the prime mortgages, on the prime brokerages themselves. Because another thing now you have to understand is, what do brokerages do? They make money. And their biggest clients are hedges. So if hedges are forced to cover, that means hedges lose money. That means the entire asset under management of the brokerage goes down. So for them, it's bad. So for brokerages themselves, they don't want the hedges to cover. So how do they play around with the rules, right? Because there's huge amount of paperwork that requires to be filled out. If they have to, when every termination of tickers happens, they have to cover and they have to re-enter their position. It's just too much work. So how would they do that? So in reality, we have a price continuation here. So TRCH's price, right? When Meta merges with TRCH, they sort of inherited the ticker movement, and they inherited the K chart or the candle chart from Torchlight, right? So then you have a price continuation of $9.9. So for regular investors who didn't follow all of the merger news, in their eyes, Meta Materials are just like Torch, okay? But in reality, they're not the same company, right? Because Torch is an oil and gas exploration company, and Meta Materials is a tech company. So then in this situation, the shorts basically rolled over their position into Meta Materials. Because essentially, the price of the stock didn't change. Does that make sense? Yes? Okay. So then, the mortgages be like, not the mortgages, the brokers be like, I will roll you over, right? And then, our number 2 right here is going to be happy. It's like, what's up, suckers? All my positions got rolled over. So I don't need to cover immediately anymore, right? Because I have an agreement with my broker. Because there's price continuation, thus, I don't really need to cover anymore. But later I will tell you that it's actually in their best interest to cover. That's why a short squeeze is still going on. And for those of you who are just panic selling, you're actually helping these people, doing the rollovers. Because literally, so in order to do rollovers, essentially all these guys have to prove to the brokerages is that they're not gonna go shit. Their position is not going to shitters, because a lot of people is not gonna hold on to, or is not gonna buy more. Sorry, I'm a bit thirsty. So then they can just hold on to their position, because what they have to prove to the brokerages is they have minimal risk. Okay. But in reality, a lot of times, when those things happen, usually the shorts will cover, because after merger happens, there's a huge upside for the people who, looking into the upside for post merger. So in reality, nothing changed from Torch, because they rolled over their short position, right? But also everything changes. What do you mean by everything changes? When the ticker goes from here to here, you transformed. It's like a transform. You transform an oil and gas company into a tech company. So your previous position or your previous due diligence for this company does not apply for this company anymore. Does that make sense? So then it's in the best interest for the shorts to actually cover. But for them, they have to sort of scare all the retail investors first. So then they will panic sell. They will have a better deal to cover. Okay, and a lot of you are gonna be like, oh my god, like if they roll over the shorts, they're not required to cover. It's gonna become another situation like AMC. It's a fucking scam. Oh no, I'm so fucking sad. No, it's completely a different situation. Because you guys know me. You guys already watched so many videos with me, right? And then you know me, like trading stock and my philosophy of trading stocks, I always have an edge. It's not like, I go into the bar and I always just go for the hottest chick in the bar because I just got no fear, right? And if I get just like face down rejected, I don't really care. And I would probably go cry in the corner of the bar or something, because I'm Asian and the white chicks don't like Asians. And then, and I like white chicks, right? But but in this situation, I will never enter a position without doing enough due diligence. Because I'm investing not only my money, but also other people's money, right? So, when I was doing the due diligence, you will see SPACs and reverse mergers are different. And according to research from 2008, reverse mergers, cumulatively speaking, when the merger closes and to a month after the merger closes, you will see a cumulative gain of this much. Okay? A lot of cumulative gain. That's why it's called abnormal gains. Because for regular stocks, if you have read the book Random Walk on Wall Street, you will know that essentially everything's random, so you're essentially looking for a 50-50 chance of having an upside and having a long downside. But for a reverse merger, you will see a cumulative gain of this much. A lot of cumulative gain. And a lot of you are like, oh my god, it's data from 2007 and 2008. Guys, situation for reverse merger barely changes in the past 12 years. But the situation for SPACs changes in the past 12 years. Okay? But SPACs and merger, as you can see from this graph here, are different. SPACs have significantly lower return than a reverse merger. And what are some famous reverse mergers? Berkshire Hathaway from Warren Buffett is a reverse merger. Okay? Reverse merger is basically another way of free up more cash flow and getting more cash from, like, say, the NASDAQ index or the listing. Why you do a reverse merger is because you want more liquidity. And by having more liquidity, your stock price will go up. That's the fundamentals of a reverse merger. And in this situation, again, I said it like so many times, you basically transfer the oil and gas company, which has been divested, right? Divested over the past 10 years. Like all of the fundamental valuations of all oil and gas companies are actually decreasing over the past 10 years. Because why? We're going green. Okay, guys, we're going green. And guess what? When you have brains, and thank you for victory.com for the brain icon. I use the free license. So whenever I use a free license icon, I have to credit them. So yeah, thank you for you guys. If you guys want to sponsor our video, please let us know. We're always looking for sponsors. So in this case, we actually transfer an old suck-ass oil company into a green tech company. So it is actually in the interest of the shorts to cover, because in the near future, this thing is going up. It has huge potential, right? Because it's a green tech company that have a lot of patents. Well, this company actually have more patents than Tesla, okay? They have more patents than Tesla, and those patents are, a lot of like futuristic technologies, right? Autonomous cars needs their nano components, or needs their stuff that they're going to produce in the near future. Aviation technology needs them. Military application needs them. So metamaterials in general, okay, it's a very high-tech stuff. And then due to their high-tech nature, there's a huge upside in the stock. Oh my god, I'm getting so thirsty right now. And so how do we combat? How do we quote-unquote force them to squeeze? Or how do we force the price action to go up? One of the things that most of the YouTubers don't tell you is the only reason something squeezes, a stock short squeezes, is by increasing volume and by having a lot of people buying into it. So when a lot of people buying into it, you will see your margin get eat away. If you were the shorts, get eat away. So then the brokerages have to call you for a margin call, right? And then what else you will see is you will see that your your potential downside increase over time. That's why it's in your best interest to cover rather than just fighting a long battle. Because for those guys, they're not gonna. So, for example, right? So for all of these people, like who were shorting Tesla back in 2018, right? Those guys lost so much money. Why? Because a lot of us buy it, right? A lot of buy, a lot of us buy, a lot of us buy, and then we buy and we buy. We force them to cover because when we buy, we force them to eat away their margins. So in reality, it's not buy and hold that triggers the margin call. It is the continuous buying where new investors coming in that literally triggers the short squeezing. Okay? I think I already explained the majority of how it works. Perhaps it's been an hour. I don't even know because I don't really have a really great time perception, maybe 45 minutes. And hopefully you guys will like this video. And so basically what you should do right now is to tell your friends the potential of metamaterials and let them buy in. And as long as we have volume shoots up, all of the shorts doesn't get short squeezed. And a lot of their advisors is gonna be like, oh my god, like all of the retard dumbers, like we the dumb people, right? We realize the upside of this tech company. That's why it's better in their interest to cover their position and maybe just ride with us. Okay. Yeah, I think this is it for now. And hopefully you guys love the video. And again, if you have any questions, please comment down below. And please like this video so we can beat the YouTube algorithm and more people can get educated on this issue. And when our community grows, we grow stronger, and essentially we have more buying powers to do short squeezes. All right, this is it. See you on the upside, guys.